Today, we are diving into a really powerful two-for-one money strategy. It's something entrepreneurs are using to get their hands on capital in just a few days, not weeks or months. And the best part, they can do it without messing up their long-term investment growth. It's all about making your money work for you in two places at the exact same time. So let's break down how it works. Okay, so picture this. You stumble upon the deal of a lifetime, a perfect business opportunity, a real estate deal, whatever it is. But that window of opportunity, it is closing, and it's closing fast. You have to move now. The big question is, do you have the cash ready to go to actually seize that moment before it's gone for good? And this really gets to the heart of the entrepreneur's dilemma. You have this constant battle between the need for speed and the reality of how slow and restrictive traditional funding can be. How do you get money quickly without giving up a piece of the company or, completely derailing your financial future? I mean, let's be real. The usual options are full of compromises. As our source material points out, sure, you could go to a bank, but you're looking at a 30 to 45-day slog through paperwork, approvals, and a whole lot of waiting. The other option, you could raid your savings, but that cash has just been sitting there earning practically nothing, and worse, losing its buying power to inflation every single day. Neither one feels like a great choice. So, what's the alternative? The experts in our source bring up a really powerful idea. What if you could become your own banker? What if you had your own private pool of capital that you could dip into whenever you wanted, instantly, and completely on your own terms? The tool they talk about for doing this is called an Indexed Universal Life Policy, or an IUL. Now, the real key here is how you get the money. You're not actually withdrawing your funds. Instead, you're taking a loan from the insurance company itself, and you're just using your policy's cash value as collateral. It sounds like a small distinction, but trust me, that one little difference changes the entire game.
And here's why that's so important. Because your money never actually leaves your account. It keeps on working for you. It continues to compound. It continues to earn interest. You're basically just using your own growing asset as leverage, while the engine, that original capital, keeps chugging along.
This is the mechanism that creates what the source calls the two-for-one money trick. It's a concept called arbitrage. It means you have the potential to earn a higher interest rate inside your policy than the interest rate you're paying on the loan. So your money is literally working in two places at once. Let's look at a real-world example to see what this looks like. Our source shares this incredible story about a real estate investor. He found a massive opportunity, a $17 million property, but he needed $1 million, and he needed it right away for the earnest money deposit to lock down the deal. Time was absolutely of the essence. So instead of going through the headache of a bank, he just turned to his IUL policy. And check out how simple the process was. He filled out a one-page form. There was no qualification process, no credit check, no hoops to jump through, and the money was in his account in just 3 to 4 business days. And get this, he could repay that loan on his own time, whatever schedule worked for him. Total flexibility. Okay, now here is where the magic happens. This all went down in 2017. The investor was charged 5% interest on his $1 million loan, which comes out to $50,000. But, and this is the crucial part, his original $1 million never left the policy. It was still in there, and that year it was credited with a 25% gain. That's $250,000. So even after paying the loan interest, he walked away with a net gain of $200,000, tax-free, on money he was already using to secure a massive real estate deal. That's the two-for-one strategy in action. Right about now, you're probably asking, wait a minute, how on earth does an insurance policy get a 25% return? That's a great question, and it brings us to the engine that powers this whole strategy, a concept called indexing. This is the most important thing to get your head around. With this strategy, your money is not directly in the stock market, so it's not exposed to risk. Instead, its growth is simply linked to the performance of a market index, like the S&P 500. The insurance company keeps your principal safe and sound, and then they use a tiny slice of their profits to buy options on that index. That's what lets you participate in the market's upside without putting your own money on the line. And here is where that protection really shines. Let's say the market has a bad year, and the S&P 500 drops 14%. What happens to your account? Nothing. You get credited with 0%. You don't lose a single dime of your principal or any of your previous gains. As the folks in our source material say, in this strategy, zero is your hero. Okay, so what about when the market does well? When the market goes up, you get to participate in those gains, but usually up to a certain limit, which is often called a cap. Think of this cap as the trade-off you make for having that 0% floor. So in a year the S&P is up 24%, you might not get the whole thing, but you could still get a really strong return, like 10.5% in this example, all without ever taking any of the downside risk. So when you put it all together, that downside protection and that upside potential, what you get over the long haul is something incredibly valuable for building wealth: predictability. You know, as one of the experts in our source explains, it's not always about having the highest average rate of return. What's really critical is the sequence of those returns. Think about it. One huge market crash can completely torpedo a traditional retirement plan. But if you can consistently avoid those big losses, you create a much smoother, more stable, and more predictable path of growth. And the long-term data really seems to back this up. According to the source, if you look at a turbulent 25-year period, the S&P 500 averaged a 6.87% return. And remember, that's taxable. But this IUL indexing strategy, just by sidestepping the major losses during that exact same period, would have averaged 8.45%, and that growth is tax-free. That's a huge difference. So what could that mean for something like retirement? Well, our source gives us an illustration that's pretty staggering. Imagine taking out $84,000 in tax-free income every single year for 30 straight years. Even after all that, the policyholder could still have a net cash value of $3 million left over at age 100. And that's all because the principal was never depleted. It just kept on compounding. So let's just boil it all down. The key advantages that our source material really highlights here are 1, the speed to get capital in just a few days. 2, the flexibility of no qualifications and no rigid payback rules. 3, the potential for tax-free growth through arbitrage. And 4, the protection of your principal from those scary market downturns. And all of this really leaves us with one final big question to think about. When that next great opportunity comes knocking, are your assets built to be a roadblock, or are they built to be the engine that lets you floor it and go seize that opportunity? It's definitely something to think about.